January 2, 1998. The Real Estate Capital Scoreboard. January 1998. Although treasuries spiraled upward as much as 0.25%, rates settled at nearly the same levels as in the beginning of December. However, the difference between 5, 7 and 10-year treasuries is insignificant, indicating a relatively flat yield curve. All fixed-rate permanent loans of various terms start at 6.625%. Short-term rates are virtually identical to long-term rates, presenting a timely opportunity to capture favorable long-term debt. No substantial changes in the equity markets, with overall yields for institutional-grade realty assets ranging within the 10% to 15% range. February 1, 1998. The Real Estate Capital Scoreboard. February 1998. The historically low interest rates of January caused many property owners to jumpstart 1998 with refinancings. The yield curve appears to be readjusting to wider spreads between short and long-term yields. Permanent fixed-rate mortgages start at 6.25% to 6.5%. The rate range varies about 200 basis points, depending upon leverage, property type, etc. Joint ventures are popular as equity capital for construction and renovation projects. Currently, office buildings are valued far below replacement cost in many markets, attracting JV funds. March 1, 1998. The Real Estate Capital Scoreboard. March 1998. Interest rates flirt with a 12-month low, but slightly higher than February. The order of the day revolves around low rates combined with flexible loan terms offered by many capital sources. Even the most complex deals attract capital attention. The lowest rates in marketplace are priced at 80 basis points over comparable term treasuries. Mortgages rates translate to just over 6% for short-term, 5 years or less, loans, and about a half point higher for 10-year funds. Equity markets remain static with 7% capitalization rates for apartments and 8.5% or more for commercial properties. April 1, 1998. The Real Estate Capital Scoreboard. April 1998. Treasury rates continued to hover within historically low ranges. After fluctuating nearly 15 basis points, rates settled at nearly identical levels of March. At the same time, mortgage spreads barely widened as about $8 billion of CMBS debt hit the market at the end of the month. Needless to say, a plethora of mortgage funds and options are available to borrowers for nearly all types of income properties.
May 1, 1998. The Real Estate Capital Scoreboard. May 1998. Interest rates remain steady, floating at nearly the levels as the past couple of months. April rates fluctuated by about 0.25% as Wall Street remained nervous about economic growth and corresponding inflation. In broad terms, current mortgage rates are about 10 to 15 basis points higher than in the beginning of the year, the lowest levels in recent years. A flat mortgage yield curve, spreads between various terms, for example, 5, 7 and 10 years, are nearly identical. June 1, 1998 The Real Estate Capital Scoreboard June, 1998. Interest rates trade within a relatively narrow range. The Federal Reserve believes that tight labor market conditions are offset by a perceived slowdown in the domestic economy due to foreign competition. In summary, mortgage rates trended slightly downward throughout May, finishing under 10 basis points lower during the past few weeks. Once again, the yield curve remains flat as 5, 7 and 10-year mortgages are nearly identical. July 1, 1998. The Real Estate Capital Scoreboard July, 1998. June mortgage markets finished in record low territory with rates dropping about 25 basis points than May. Now, interest rates are at the lowest levels of 1998. The yield curve remains slightly inverted as the 10-year notes sell lower than 5-year obligations. In other words, longer-term interest rate expectations are bode for more stability. September 1, 1998 The Real Estate Capital Scoreboard September, 1998. August closed as one of the most gyrating months in modern history. Despite treasuries dropping nearly 50 basis points, mortgage spreads widened, virtually canceling any rate reduction benefits. Spreads between various terms broadened, for example, 10 basis points increase of 5 versus 10-year terms. The extremely strong demand for mortgage funds creates a glut of CMBS issuance. To protect mortgage yields, lenders require floors regardless of Treasury rate drops. The current 10-year floor is at 6.5%, for instance. November 1, 1998. The Real Estate Capital Scoreboard November, 1998. Market volatility continued throughout October. On a positive note, spreads are narrowing between mortgage-backed securities and treasuries. The correlation between treasuries and CMBS notes is approaching a more balanced relationship. Overall mortgage rates are priced starting at 6.5% based on established minimum floors. 10-year, fixed-rate debt pricing starts at 6.75%. Higher quality projects attract funds from numerous pension funds and life companies. In fact, these sources enjoy renewed popularity for lower leverage projects with strong cash flows. All in all, rates are highly competitive in relationship to historical levels. December 1, 1998. The Real Estate Capital Scoreboard December, 1998. Debt markets are relatively unchanged from November. However, equity market repricing is starting to trickle in. Capitalization rates moved higher as the year-end approaches, about a quarter point or more. The adjustments are a direct result of market fears and rising interest rates. Premium quality properties continue trading at near record levels driven mostly by tax-free exchange buyers. Since right prices are somewhat favorable, major public players focus on mergers and acquisitions of underpriced companies instead of purchasing individual realty assets. Going-in cap rates start at 8% for apartments and net lease deals, while other commercial properties trade at 8.75% or more.